Welcome back everyone, my name's Paul and today I want to show you some of the top UK stocks that everyone is talking about. And let's see if they're worth buying right now.
Stocks.
With the recent news about the Evergrande debt problem, there's been a few UK stocks that have come down in price recently. This has led some people to think that these stocks might be a buy. So I'll be looking at a few stocks that might be affected this week and see if we can find some value. But first, let's have a look at the portfolio. I'm currently sitting at 36,292. This is a dividend reinvestment portfolio, and I show this portfolio every single week to show you exactly what's going on in the market. I feel very accountable to you and to my videos, so I try to show this portfolio as much as possible. I try to show the good and the bad each week because this is an experiment to see if this style of investing actually works. I've read a lot about previous investors having a lot of success in this value investing style approach. And just over a year and a half ago now, I started with nothing and I'm trying to build this portfolio up to see if it can lead me to some sort of financial freedom. And this month it's been really rocky. At its peak it was around 37,000 and at its trough it was around 35,000. And if you listen to long-term investors, this is very, very normal in the market. The key to this investment strategy is knowing what you own and having a reasonable understanding of very good businesses with high cash flow producing assets. Up until a month ago, all of this was green, and now I have 1, 2, 3, and 4 stocks that are in the red. AT&T is my biggest loser so far. I expected this to happen, if I'm honest. You might have seen one of my previous videos on AT&T. It's always supposed to have been a stock that has a lot of short-term pain, but hopefully in the future there's a lot of long-term gain. Bristol Myers Squibb is another stock that has been flat for years. However, this company's revenue grows brilliantly and they've got an excellent pipeline for drugs. So as soon as I've got a little bit of money, I'm going to be putting more money into Bristol Myers Squibb. And because of this recent problem with the Evergrande, the Vanguard FTSE Emerging Markets ETF has taken a bit of a beating. This is because the Evergrande company, which is a real estate company in China, has taken on way too much debt and it reaches out to way too many people. Many economic experts are predicting a credit crisis. Whether that happens or not, we don't know. And this is likely to cause a very big dip in the markets all over the world. The key to investing is to know your businesses and try to buy really good businesses that will transcend stupid news like this. One of the companies that I own that has taken a big beating right now is Rio Tinto. And it was one of the first companies that I was asked about when this Evergrande crisis started happening. Evergrande is a company that owes a lot of money to a lot of people. It promised to build a lot of houses and these people that were going to live in them have already paid for them. These houses and apartments that were supposed to be made all required a lot of iron ore. So much iron ore, in fact, that China was the leading iron ore importer by an absolute mile in 2019. The amount of iron ore that China imports is incredible in comparison to every other country in the world. And this led to a huge spike in iron ore prices, which this week, because of the Evergrande issue, has started to correct a little bit, meaning that all companies that make money from iron ore are going to lose a lot in earnings. And according to Genuine Impact, Rio Tinto makes 61% of its revenues from iron ore. This led to a sharp decline of about 7% over the past 5 days. Over the long term, we can see Rio Tinto is a compounding stock, but it is very cyclical, going through many peaks and troughs over the years. But the long-term compounding from 1989 all the way up to September 2021 would have earned you 1,000% in gains. Over that time, you would need to have the stomach to deal with this cyclicality. For instance, from 2006 to 2016, you would have endured a 33% loss for well over 10 years. But this is long-term investing, and if you can find good fundamentals in these companies and hold them for the long term, they should pay off. Long term, helped by great dividends, helped by Rio Tinto paying back to its shareholders, Rio Tinto has outperformed the S&P 500 by about 3%. And currently Rio Tinto's price does show that it is under its intrinsic value. However, we all knew that this iron ore correction was going to come eventually. We just didn't know when. Analysts have expected it to happen at the end of 2021, and they might have timed it perfectly right. Over the next 2 years, we're likely to see quite a heavy decline in iron ore prices, and therefore quite a heavy decline in earnings and revenue from Rio Tinto. But the share price even right now, is still below those analyst estimates. And if you take those analyst estimates, which have historically been over-projecting exactly what Rio Tinto might earn in the future, you could still, including dividends, be in line for a 35% upside. Rio Tinto is currently yielding at around 9 to 10%, which is absolutely crazy. Prepare for that to be cut, which is why I think the share price still hasn't seen the lowest point yet. So it might be in the short term that we see a little bit more come off Rio Tinto's price. And Rio Tinto is not bothered about cutting its dividend. It does the best for the business and therefore, in my opinion, the best thing for the shareholder. It seems to deliver when times are good and cut back when times are bad. But the long-term trend of its dividend, even though it does fluctuate a lot, is upwards, and that's why it makes it onto my list as a dividend grower. Looking at the income statement, we do have a few highlights and a few negatives. For instance, shares outstanding have been dropping over the past 10 years. This is great to see, as it means we get much more of their pie, and every time that they pay us a dividend, because they're taking some of the shares back again, they save even more money. They save 8% of their dividend payment. And when we look at the long-term revenue history, we do see the cyclicality of this business. Lots of new revenue and acquisitions when times are good, and lots of declining revenue when times are bad. In 2013, Rio Tinto did one of the biggest write-downs it's ever done. This all happened in conjunction with a lower iron ore price. Remember, these mining stocks basically follow the ore price, and finding Rio Tinto when the prices are more like 60 rather than 215 is probably a good idea. It's also worth noting that Rio Tinto makes a lot of money from copper, about 20% of its revenues, and copper is also due for a bit of a squeeze at the moment. Rio Tinto's profit margin is again very cyclical, so it's best to buy this company while it's on a bit of a downtrend. But it's worth noting that this company has never been close to going out of business. It always keeps a lot of cash on hand, and it's always expanding into different markets. So I'm not going heavy into Rio Tinto right now, but I am still buying bits. And while the price goes down, they are usually paying around a 5% dividend. I can just sit there and take up that dividend while I wait for the price to appreciate again, and while I wait for the next cycle to come round. The next UK stock everyone's been talking about is ASOS. ASOS has recently had quite a big decline over the past month or so. And for the past year, we've seen a 44% decline. ASOS is a clothing retailer. Think of it as Boohoo without the slavery. I actually used to really like ASOS. I used to buy lots of clothes from here until I realized that I could just buy clothes from Primark. But this decline has been caused by two things really. First, we've got a possible Chinese credit crunch, which is where ASOS gets a lot of its clothes. But the ASOS decline is mostly due to sales over the summer not doing as well. Because we weren't able to travel and go abroad, that meant that summer clothes didn't do very well this year. And the news of this sent ASOS's price plummeting. Now, an excellent value investor might say, this is just 1 year. Next year, the planes will be flying, the sun will be out, and everybody will be buying clothes again, and ASOS will just go back to business as usual. It'll have had this blip in 2020, but it's going to be a strong business for the future. Earnings for ASOS show a steady incline for the past 10 years. The analysts even see a bit of an upside over the next 2 years. We're often diluting our shareholders, going from 43 million shares all the way up to 84 million shares. So over the past 10 years, they doubled the share count. But just look at this exponential curve going on with ASOS's revenue. Absolutely amazing. Net income looks pretty good as well. With this little blip here, I think we can understand what that was all about. But to survive 2019 and 2020, this company did have to take out its first amount of debt. The debt hasn't affected their current ratio too much, so this company does seem to be quite safe, at least in the short term. Some of the key issues that I do see is this declining net profit margin, so things are getting a little bit harder for them to actually make money out of their revenue, but this revenue growth is very, very hard to ignore. Now, for a projected share price growth, it may be that ASOS has started to present a bit of an opportunity. No dividend yield, so don't expect any cash back so far. This has all got to be grown on share price growth. With that revenue growth, I'm happy to apply a PE of 20 at the end of 2027. And with this calculation, we can see that we have an 11% year-on-year growth prospect over the next 5 years. If things don't go as well and we have a 15 multiple going into 2027 and maybe a little bit less growth over the coming years, we still do have the opportunity to make money. It would take quite a lot at this price for ASOS to actually lose money. Even with quite a significant contraction in growth, it does seem here that ASOS has some sort of margin of safety. Oh, I do cream over some margin of safety. So if you're into your growth investing, ASOS might be one to have a good deeper dive into and see if it's still going to keep up that growth over the next 5 to 10 years. Another stock that's suffering a little bit from the China crisis is Associated British Foods. ABF owns some massive brands in the food industry like Kingsmill, Ovaltine, Ryvita, Patax, some big old brands from that consumer staples industry. But whenever analysts are looking at ABF, Primark always seems to take the headline. And there's no doubt that Primark has taken a massive beating recently because it doesn't have an online store. I still have no idea why Primark doesn't have an online store, but they seem to make this work, and Primark and ABF appear to have no plans of taking Primark online at all. On the news of Primark's acquisition, ABF absolutely took off, and for the past 5 or 6 years now, we've seen a 45% decline. ABF's long-term earnings have always been a little bit choppy, but they've always had this strong upward trend. But ABF is a classic example of a stock that just got way too ahead of itself. When really good news takes off, investors get into these stocks. They see all of these amazing things that could happen in the future, and when it doesn't pay off in the short term, the price just implodes on itself. I can see a lot of hot stocks all around the world that are suffering from this right now. And ABF could be a very good example of mean reversion and what could happen to all of those stocks all around the world that have become a little bit hyped through 2020. But ABF's price right now could present a new opportunity. As a dividend growth investor, I do love how their dividend was persistently growing over the course of time. Only in 2020, when it was absolutely necessary, did they cut the dividend, and it looks like they are talking about reinstating that dividend very, very soon. Free cash flow has always been a little bit choppy. You can see here where they've been making acquisitions, but even in 2020, when Primark was completely shut, they still were able to achieve a free cash flow higher than their dividend payment. That to me is a sign of a very resilient business. Outstanding shares have been flat since the dinosaurs, but revenue over the past few years hasn't been as great. This company seems to have stopped growing its revenue over the past 10 years. It's not like ASOS that we saw earlier, which was like a... This should be worrying for ABF investors and maybe something to consider going forward. Net income has also been declining for the past 3 years. 2020 doesn't really count, but still this is a little bit worrying. And looking at the revenue and the income statement over the past 5 years, this does make me start to think that ABF might not be that brilliant business at that low price as we first thought. Free cash flow over the past 20 years and more importantly the past 5 years has been growing, so you might want to see here why this free cash flow has been growing. Has there been a lot of debt being taken on? Let's take a quick look at that. Yes, so in the past year they've taken on 5.3 billion in debt. But prior to 2020, this was a very low debt business. So looking forward, the analysts have it growing at a 95% rate next year. That's very possible. The shops are open, so it's going from 0% last year all the way up to 95% this year. So I'll give them that one. But a 40% growth going forward is very unlikely. So I'm going to give them a very small growth rate going forward. And I'm also going to contract their PE ratio, which is usually around a 20, back down to a 15. And I think this is possibly quite a realistic scenario, especially over the next 5 years. I wouldn't even say this is the worst case scenario. I think it could get much worse for ABF. So at 7.3% annual return going forward over the next few years, that's including a little bit of dividend growth. I don't think ABF currently has a great margin of safety. And if I wanted to buy into Associated British Foods and therefore Primark, I do want to wait for this price to drop a little bit more. I want to be looking for this share price to drop down to maybe 1,500, maybe even 1,300, just so I can be a lot more confident that there's more upside than there is downside. National Express has been very, very popular over the past year or so, especially on the Discord. And because both Stagecoach and National Express are both having a bit of trouble at the moment, they're both looking into a 400 million merger. Historically, National Express doesn't look so bad with revenue growth going forward, and it had quite a lot of income growth and it was expanding into the US and other countries. But I see absolutely no reason why you would want to buy Stagecoach right now. Exponentially declining revenue since 2018. It's also taking on debt, so much debt that it's now outweighing its liabilities. I can't understand why as National Express you would want to buy Stagecoach other than for the fact they might have some contracts that you don't have. For a quick trade though, at 445 million, that could possibly put you at an 18% arbitrage upside if you were to buy Stagecoach today. So if you believe or you have some insider knowledge that this deal is actually going to go through, then Stagecoach is actually worth 18% more than it is right now. But on Thursday, when this has been recovered, a lot of the market is recovering from the bad news of the week. So my portfolio now sits at 36,502. Thank you very much for watching, guys. If you enjoyed this video, please feel free to like, subscribe, and invest. And if you wanted to sign up to Trading 212, you can sign up through my link in the description below. If you sign up, you can get a free share that's worth up to £100 when Trading 212 opens up again.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.